Title: What you need to know about the new capital gains tax rules and capital market investment in shares. Overview: There have been recent discussions, and even some misinformation, about the new capital gains tax reform and its impact on the Nigerian capital market. While full implementation guidelines will come later, it is important to clarify the key issues now. The new CGT framework is a major improvement. It makes investing in the Nigerian capital market more attractive, reduces risks, and allows investors to claim legitimate costs. Overall, the reform promotes fairness, equity, and confidence, not the opposite. Reform objectives: reduce investment risk by allowing deductions for capital losses and other genuine investment-related expenses, protect small and institutional investors through exemptions for retail investors, pension funds, and REITs. Harmonize tax rules by aligning CGT with income tax for better consistency and easier compliance. Key changes: 1. The former flat 10% rate is replaced with progressive income tax rates ranging from 0% to 30%, depending on the investor's total income. 2. The 30% top rate, which applies to large corporate investors, is expected to drop to 25% under the broader tax reform. 3. Investors can now deduct costs that were previously disallowed, ensuring no one is taxed while in a loss position. Exemptions: the following are exempt under the new CGT rules: transactions within 12 months where total sales are not more than 150 million and total gains do not exceed 10 million, reinvestment of proceeds into shares of Nigerian companies within 12 months, capital gains from foreign shares brought into Nigeria through CBN-approved channels, PFAs, REITs, NGOs, and other tax-exempt institutions, small companies with turnover under 100 million and fixed assets under 250 million, gains from investments in labeled startups by venture capitalists, private equity funds, accelerators or incubators. Determination of gains: from January 1st, 2026, the cost base of existing investments will be reset to the higher of the original purchase cost, or the closing market prices at December 31st, 2025. This ensures fairness and prevents taxation of past, unrealized gains. Allowable deductions: investors can now deduct realized capital losses, brokerage fees and regulatory charges, margin interest and verified FX losses related to the investment. Registration and compliance: resident investors must obtain a tax identification number. Non-resident investors with only passive income do not need a tax ID, self-assessment applies by default, though withholding rules may come later. All taxes are payable in Naira. Filing deadlines: individuals, March 31st of the following year, companies, within 6 months after year-end, non-residents, upon disposal, unless reinvestment is expected within the same year. Administration: individuals pay CGT to their state of residence, companies file with the Nigeria Revenue Service, non-residents may pay directly or through an appointed withholding agent. Additional clarifications: corporate reorganizations such as mergers or restructurings are exempt, gains up to December 31st, 2025, are grandfathered and taxed based on the old law. Investors must keep proper records of costs, proceeds, and expenses, the policy is not revenue-driven. Its goal is fairness, competitiveness, and investor confidence. In a nutshell, the new CGT framework is fairer, globally aligned, and more investor-friendly. It reduces risks, protects small investors, encourages reinvestment, and ensures large investors pay their fair share, but only on realized gains that are not reinvested. Subscribe for more and share with your friends and associates. See you.